Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsati. And in this Let's Talk Bonds, we talk about the warning signals sent by the market to corporate bond investors. The 3 points that you will get from this podcast is one is that spiking government bond yields. The second is the stock corporates are struggling to raise funds. And the third is a potential liquidity squeeze for weaker and fundamentally poor corporate bond borrowers. And these are the main warning signals, and investors have to be extremely wary when they are looking to invest in corporate bonds. Do not forget to download our app, Quick Invest by INR Bonds, where you get the best information and our own proprietary risk score that takes into account all these factors while rating a bond risk and does not really look at the credit rating of the bond, as that is, we see that as not very market driven. But here the market is driving corporate bond yields higher, and the corporate borrowing costs will rise very sharply as liquidity freezes for the uh, non um, non-strong borrowers or weaker borrowers or fundamentally weaker balance sheets.
It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Coming down to the first point, the government bond yields are spiking. In today's auction, the one-year government bond yield saw the cutoff at 6.14%, and the RBI had to give the underwriters a major percentage of the auction as the demand was weak, and the markets had asked for higher yields in the auction, fearing rate hikes by the RBI and a potential money squeeze in the market. So there is a lot of issues in the money markets, because with the weak rupee, RBI has been selling US dollars, and that is taking out a lot of liquidity from the system. Along with that, you have a capital outflows that is also hurting the liquidity sentiments, and also that RBI is in a tightening policy mode given inflation expectations are running very, very high. This spiking government bond yields is hurting corporates also to borrow. There are a lot of issuances that have been seeing weak demand. One is NABARD, that was floating a 3-year bond. NABARD is one of the best credits in the country. Is floating a 3-year bond. They cancelled a rupees 5,000 crores or 50 billion auction, as the demand was at higher yields than what the corporate had expected. HDFC is looking to raise rupees 120 billion of bonds, and they raised rupees 70 billion or 7,000 crores, very largely taken up by the Life Insurance Corporation of India. So they didn't really come to the market to raise the bonds, fearing that there will not be enough demand by the other investors. Now, with many top corporates struggling to raise funds, many of the others were going abroad to raise funds earlier, given that there was a lot of liquidity floating in the market globally because of central bank policies, are now finding that the markets are shut for them, and there is no money being given to any emerging market borrowers, especially the weaker ones. With the US Federal Reserve struggling to contain inflation, there is a huge fear factor in the markets globally. And while earlier markets were pretty much open for all kinds of bond investors, now the markets are completely shut. So many corporates will not be able to raise foreign capital funding, while domestic capital will also be scarce, given that there is a huge amount of liquidity pressure in the market. So what does this mean for corporate bond investors? Then clearly there seems to be a liquidity freeze happening for many borrowers, especially the weaker ones. The weaker ones were able to raise funds in the last couple of years because of ultra low rates and so much of money. Corporates, investors were searching for yields, and now many of these borrowers are going to struggle and to raise funds. And also that if they don't raise funds, they might find it difficult to actually service the debt raised. So this is a very classical case of liquidity freeze. And this is what INR bonds, and I have been highlighting in the last couple of months about the potential liquidity freeze as inflation takes over of the global economies. And we had spoken to it extensively in many of our research posts, as also in all our interactions through YouTubes and other media. So, for corporate bond, what is the message for corporate bond investors? Clearly, the warning signals are there. They have to be extremely wary of which credit to invest in, even though they might want higher yields. They'll have to be extremely careful of which bond they are selecting. How will the company repay that debt with the bond when it comes up for maturity? How will they service interest? Are the promoters strong? What is their asset quality? If it's a what is a manufacturing company? What is the potential for any disruptions in business, or will the cash flows be healthy? So investors may have to bide the time or search for the or look at platforms like INR bonds, where we give you all the information that you require along with our own rating of the risk, which is based on a lot of market factors on our own model. So with this, I think corporate bond investors are being served a warning, especially financial advisors and investors who have been investing with looking at the yields will now have to look very, very closely at which issuer they are looking at. And this is a very tough time for investors as well as issuers of bonds. Good issuers will always be able to raise money, but they might have to pay higher rates. And as such issuers are the ones that investors will have to look at. Thank you very much for listening into the podcast. To follow us on Spotify, Apple Podcast, Amazon Music, YouTube, and thank you again. Any comments you have, we can always DM us on Twitter or reach out to us through our platform website or download the app where you can reach out to our customer support. And if you have any questions, if you have any comments, please do send it across.